In Chapter 5, we're looking at itemized deductions. Now, these are going to be from AGI deductions, so below the line deductions, as opposed to the for AGI or above the line deductions we previously looked at. In Learning Objective 2, we're going to take a look at the deductibility of state and local taxes. Here, we're going to look at four specific taxes that can be deducted on that Schedule A for lines 5 through 7 on the schedule. Personal property taxes are going to be those on something like a personal vehicle. Real estate taxes are going to be something like those on a personal and primary house or home. Other state and local taxes listed here, an example of that might be a state income tax. And then foreign taxes are going to be those taxes paid for governments other than those related to the United States. And based on the Tax Cuts and Jobs Act of 2017, it's important to know these state and local taxes are going to be limited in terms of the deduction that can be taken to $10,000. And that if you are married, filing single as your status, that that limitation gets split between the two spouses, so $5,000 for each spouse. With respect to the personal property tax, there's a three-pronged test that we're going to look at. The tax paid in order to be deducted needs to be on personal property. It needs to be something for like a personal vehicle, not for a business vehicle that might end up on Schedule C as a for AGI deduction. And it needs to be an ad valorem tax, so on the value. So maybe a registration may be included in this if it's based on the valuation of the vehicle, but also if a direct ad valorem tax by the state or local government is, then that's going to be included as well. And the third prong is going to be that it needs to be imposed on an annual basis. So the sales and use tax that's paid on the purchase of the vehicle would not be included in this, but rather the recurring tax for continued registration and ownership of the vehicle. For the real estate taxes for deductibility, we're talking about personal residential home in order to be filed on the Schedule A and itemized as a from AGI below the line deduction. If you own rental property, that's going to actually get placed on the Schedule E and would be a for AGI deduction above the line. If the real estate was purchased during the tax year, then those taxes paid for the real estate would actually get split between the purchaser and the seller based on when the closing date was. Other taxes, so for state income tax payments to be deductible, those are going to get based on the payments, whether it's through withholding taxes paid, estimated tax payments, or through the filing of the prior year's state return. Now, if this is done and the taxpayer receives a refund, it's important to note that that would be included as income based on the tax benefit rule. So if you paid more taxes than you actually owed and took the deduction for the additional taxes, you don't get the benefit of that and then keep with the current deduction in the year. You have to take the income to essentially offset it in the current year. So some states also do not have a state income tax. So it's important to note that tax filers that want to take this deduction actually will get an election between whether to use state and local income taxes or state and local general sales taxes paid during the year. Those state and local sales taxes paid can be calculated based on the actual sales tax. So if you essentially collect your receipts and know how much sales and local sales tax were paid, those can be deducted. Alternatively, you're allowed to use the tables that are set forth by the IRS. And an example of that would be where if a married couple with no kids earning $75,000 in St. Charles were to look on the table that the IRS has on their website, and input that data, it would list 1,430 as the estimated state and local sales tax paid for the jurisdiction. So that can get used instead of actually collecting the documentation of the sales and state and local sales tax paid. And then foreign taxes are also deductible to where if earnings were generated outside of the United States, and then taxes were paid to the jurisdiction in which those earnings were made, there's going to be some offset for the taxes paid, either a credit or a deduction. Now, even though the itemized deduction is a possibility for tax filers, it's important to note that the individual taxpayers are going to prefer the credit, and the reason for that is as opposed to just a deduction, the credit would be a dollar for dollar reduction in the taxes that need to be paid. So that's going to be more beneficial to the tax filer in most circumstances. Taking a look at our concept checks here, for personal property taxes to be deductible, they must be based on the fair value of the property, and we know that that is true. When property is sold during the year, only the seller is allowed to take a deduction for the taxes paid, and we know that is false. It would be split between the purchaser and the seller. Concept check 3, the tax benefit rule states that if a taxpayer receives a tax benefit when an expense is paid, no further action is required on the taxpayer's part if a refund is received in the future, and this is false. And for the overall dollar limitation for the deductibility of state and local taxes is $11,000, and we know that's false. It's a $10,000 limit for those deductions.